been asked in recent days, what's the potential impact of rising petrol prices, which are rising quite sharply at the moment, on the property market in South Africa, the direct and indirect impacts. Now, this relates, I guess, to a certain degree to my previous video about the potential of the impact of the Ukraine conflict, because petrol price impacts from here onwards could be in part due to higher oil prices as a result of the Ukraine-Russia conflict and fears in the oil markets of supply-side disruptions. So it's all related. But let's zoom in on petrol prices and ask ourselves the question, what is the potential impact? And I'm going to, now, it's a kind of a how long is a piece of string question. The impact is negative for economic growth. It fuels inflation, which eats into disposable income of consumers. Those are the basic impacts of higher petrol prices. But interesting, just to give one a perception perhaps of where we are relative to something. I'm going to compare us to the global financial crisis of 2008, where we also had a recession. 2008, late 2008 and into 2009, we had an economic contraction of sorts. Now, why am I comparing the two? Well, because there's some remarkable similarities. What threatens us now is an oil price shock. Brent crude today, when I last looked, was at $127 per barrel. That's up since this conflict in the Ukraine started, from below $100 a barrel. So it looks like we're going to have a further petrol price hike at the end or at the beginning of April. It's early days in the month, but it looks that way. But there was an oil price spike in the global financial crisis too. That time around, $150 a barrel. So we're not looking as extreme yet as what we were back in 2008. But there were these two periods were both characterized by oil shocks and oil price shocks. With this one a potential shock. I wouldn't call it a full-out shock yet, but looking ominous. But oil price shocks generally take the world economy significantly slower in terms of economic growth and often even into a recession. But then there's a food price element too, which we mustn't forget. So I'm not just going to talk about petrol price hikes. The Ukraine's a big agricultural producer, and it is said by agricultural economists that this could fuel food price inflation globally, agricultural food price inflation. That typically feeds through to South Africa as well, with sort of semi-globalized prices, if you want to call it that, which can be useful for the agricultural sector's producers, but not necessarily for the consumer. So we can have some dual factors, food and oil, driving a CPI inflation surge in South Africa. That's the first potential impact. So I'm going to include food in it, although the question is typically about petrol prices at the moment. What is the first impact of this? Well, it can eat into disposable income of consumers. Before interest rates have even responded, because the SARB has an inflation target, just the inflation surge alone, which comes quite quickly from these factors, and wage inflation doesn't normally catch up without a considerable lag. For a time being, you have inflation eating into consumer disposable income, and that hampers their real purchasing power at the mall. So it has a direct impact on retailers. In 2008, a dual global oil and food price inflation shock. How bad did it get? Well, back in 2007, CPI inflation rate was below 6%. By August 2008, it was at 13.7%. Double digits, well up from where we've seen, and we haven't seen it at that level since. Am I predicting that now? No, I'm not at all. I don't think you can predict it. It's a risk. Our forecasts for inflation aren't anywhere near at the moment. And in a pretty subdued economy with limited producer pricing power, it's difficult to see producers passing on such inflation to the consumer. So far so good. We're not there yet. The January, the most recent inflation rate was at 5.7% CPI. Could now go higher potentially depending on where oil prices go to, but it's definitely not 13.7% yet. That's probably about all we can say now, because this conflict and the sanctions and the boycotts and the supply disruptions are impossible to predict. So that's the first potential impact. Inflation eats into consumer disposable income, which eats into mall spend, real mall spend. The second potential impact is the interest rate impact. What does the SARB do given its inflation target? And it wants to dampen or curb second round inflationary effects, producers passing it on, inflationary expectations getting anchored at higher levels. So it typically responds to any rise in inflation. It has been already. We've had 225 basis points worth of interest rate hikes. But again, we're probably in a better position. Not only are oil prices now still significantly lower than back in 2008, and inflation to date is still low, but that's early days. But interest rates now 7.5% prime rate after 2 hikes. Back in 2008, rates had started from prime rate 10.5% and in 2006 and risen all the way to a peak of 15.5% by mid-2008. That's quite severe. At 7.5%, also still very tough to imagine that we'd ever get anywhere near 15.5%, and certainly to date those aren't our forecasts. Then there's another factor which I believe puts the consumer, from a direct impact point of view, puts the consumer in a better situation than in 2008. 2008, the consumer had just finished cranking up its debt to disposable income ratio to 79%, the highest on record ever since records started. That ratio is today significantly lower at 68%. So even if rates were to get to similar levels of 2008, the debt service ratio, the cost of servicing all that debt as a percentage of disposable income, would probably be noticeably lower still than back in 2008. It was a level of very high debt after a housing bubble and a consumer credit-fueled bubble. Crazy days in the build-up to the consumer and housing boom years and the build-up to 2008. So we're less indebted now, and that's to the consumer's benefit. So the consumer might not take as much of a pounding were inflation and interest rates hypothetically, purely hypothetically, going to get to the extreme, well, what looks now to be extreme levels of 2008. Even then, the consumer might be more cushioned because of a lower level of debt to disposable income ratio. So that's useful. But the consumer nevertheless takes a knock. And the problem with retail property is the tenant side, the retailers themselves, who are probably on average in a weaker financial position now than what they were in 2008. So it wouldn't need as big a consumer knock perhaps to take more of them into trouble. And I say that because if we look at TPN's tenants in good standing percentage, retail tenants are only at 64%. That's a very low percentage of in good standing with their rental payments with their landlords. They haven't recovered to pre-COVID levels yet. And I think this is the problem we have now, is that while we can't say that the oil and food price inflation shocks and the global shock from or any potential shock to the economy from the war in the Ukraine will be as severe as what it was in 2008. We can't say that. We can't forecast this. We can't predict it. But even if it wasn't, the problem is the build-up in South Africa. A stagnating economy from 2012 to 2019, prior to COVID, was very different, and it put more gradual pressure on businesses on average than the build-up to the global financial crisis in 2008, where we had 5% plus economic growth for a couple of years. It was boom times then. Maybe crazy, maybe unsustainable, but boom times nevertheless. Then we've had more pressure on the business sector, of which retailers are an important part, with the biggest economic contraction in 100 years in 2020 with the lockdowns. And now last year, we still hadn't got back to a GDP level of 2019. So coming into this period of rising inflation, rising oil prices, rising food prices potentially, and speculation about that, we've got to remember that the build-up for the business community to it was a lot harsher than the build-up to the global financial crisis recession of 2008, 2009. And that's important. So while the consumer might not be in as bad a shape, depending on how bad this gets, it would possibly not take as much of a knock to the consumer to put the retailer population under very severe pressure. So there's significant risks on the retail sector, the retail property sector, nevertheless. The other interesting one to speculate about is the office property sector. What happens there? Well, and again, like the retail sector, it's all unknowns now because the whole Ukraine conflict, the whole oil market, so the sustainability of current price levels is all very much up in the air depending on supply disruptions. It's, these markets are highly speculative too. But the one thing that has also changed, is different for households from 2008 to now, from now compared to then, is the ability to be more mobile and work from home. It's been tried and tested and forced on us en masse during the lockdown. And for those of us who can, the office working population who can, it is a viable option. The question now is, with rising petrol prices and already the unpopularity of going back to the office amongst a sizable portion of the employee population, one of the big factors is transport costs, commuting costs. Financially, in terms of running the transport that you use, in South Africa's case, a lot of private transport too, which doesn't help for middle to higher income individuals. And of course, then time costs as well, congestion costs. That's a different issue. That's not relevant here when it comes to petrol price costs. But does a petrol price spike then delay the full return to the office? Now, full return to the office is not the levels of office work that we saw back in 2019 prior to lockdowns. I don't believe we're going back to those levels. But there has been, this was the year I'd expected some normalization. And it's important to get some sort of normalization from an office landlord point of view, because companies aren't going to sit and stare at these empty offices that are costing them money forever. The longer that carries on, the more the risk of companies cutting down in the amount of office space that they hold. And that's obviously a challenge for the office property sector. So we've just come out of hard lockdowns. Lockdowns are pretty much done with. And we've been looking like now it's a normalization of office working activity back to whatever the new normal level is post-lockdown. And now you have a petrol price spike, which in 2008 was not an issue at all, or not much of an issue, because most people had not tried work from home. We weren't geared up for it like we are now, and it was not as acceptable in the office sector as it is now. So does this mean a scurry of a significant size of or portion of the working population, the office working population, back home, and a delay of the return to normal in the office? And then the question marks of how much office space do we need that keep on coming? That's the one to watch now and see if there's any impact of higher petrol prices on the office working population's working habits, and a possible delay of return to whatever normal is post the lockdown in terms of office work versus remote work.